We've just seen another week of huge inflows into gold ETFs, but can they retain their allure? Last week saw the largest inflow into physically backed gold ETFs since March 2022. That was when global markets were grappling with the immediate consequences of Russia's invasion of Ukraine. Looking at the performance of some of these funds, it's not too hard to see why. Just look at how the largest one out there has done. That's SPDR's Gold Shares, GLD. And if we look at gold miners ETFs, the performance is even better. So can this performance be sustained in 2025? Bryan Armour is Director of Passive Strategies Research at Morningstar. Bryan, first of all, can you explain how gold ETFs work as a hedge compared to physically owning gold itself?
Well, in many ways, it's the same as holding physical gold itself because these ETFs, at least the grantor trusts, actually hold the physical gold in a vault, and so every investor owns a piece of that. In many ways, it's the same, and obviously a lot of the storage costs and actually transferring that gold is done by the ETF itself.
Now, US listed funds led the inflows last week. That's according to the World Gold Council. But in January, they actually saw outflows, whereas in Europe, they experienced positive flows. Why was that?
It could be for many reasons, but generally, gold has worked well as a safe haven asset among global volatility, and obviously there is a lot up in the air right now in terms of geopolitics. I think anytime we see a bit of a fright within any region, we see a push into gold, and so that could be part of it. Could be a way to get out of some of the currency risk, but just in general, there's less certainty and certainly uh, volatility on the horizon, and so gold can help with that. And maybe U.S. investors don't feel that same pressure as European at this point.
But why are gold miner ETFs easily outperforming those linked to physical gold at the moment?
Yeah, so miners in for any commodity, think same as oil and gas producers, they almost form like a leveraged exposure to the underlying asset because when the price goes up, they're not doing anything different than they were. So it just generates greater profits, more revenue for the companies. But generally, it's not as simple as a straight line leverage exposure. A lot of these companies have their own idiosyncratic risks that can derail performance at any given time. But for now, when the price is rising and operations are as usual, it's only a good thing for gold miners.
Now, we saw recently that strategists at Goldman Sachs lifted their price target on spot gold to $3,100 an ounce. So, can we expect these funds to continue 2025 in the same way they've started them?
Well, that remains to be seen. I think price targets are notoriously difficult to get right. And so the way I would look at it is just bolstering the diversification and the durability of a portfolio, and adding a allocation to gold can do just that. But that's not to say that I expect the price to go up to a certain amount or anything like that. But it certainly is in position to provide some long-term performance amid uncertainty and potential crises for certain regions.
Now, Bryan, which ETFs in this space have caught your eye recently? And are there any you think investors need to be particularly wary of?
Yeah, well, so with the grantor trusts, they all for the spot gold ETFs, they really hold the same thing. So they're, any difference in performance is just going to come down to fees for the most part. GLD was the original gold ETF. It's the largest gold ETF. Started in 2004. There's lots of liquidity. It makes it a great trading vehicle. But for buy and hold investors, you can get cheaper gold ETFs, and even one of those is even from State Street as well, whose net expense ratio is 30 basis points less than GLD. So GLDM, IAUM are two of the best ones that offer low fees and also high liquidity. The only other thing I would say is with gold miner ETFs, They're notoriously volatile, and especially the leveraged and inverse gold miner ETFs are particularly dangerous, so I would avoid those at all costs.
That was Bryan Armour from Morningstar. And that was your look at gold ETFs. I'm Ramzan Karmali, and this is Reuters.